Hello, everyone, and welcome back to Your Finance TV. As is always the start of a month, we get Jay with his monthly summary. How are you, Jay?
I'm good, Scott. Happy it's Friday, right? And it's even supposed to be sunny tomorrow.
I know
Who
how
knew?
good's that. All right, now, but listen, what's just happened in the markets? And that is the title of your monthly, What Just Happened. Can you explain to all the viewers what the hell just happened?
Well, that is the question, right? And remember last week the title was flip flop, and so we've had a continuation of that with markets flipping around, big moves one day to the next, and really, what it reminded us at TPW Advisory was how valuable it is to have a process, right? It's always important to have a process in global macro land because global and macro means you're looking at everything. And a process helps you stay grounded. And it's something we've learned over, decades of experience to have a process. And importantly, at times like this, we have a process of writing our weekly musings. And then at the end of the month or beginning of the month, we do a once a month monthly. And that is the work that we've done this week. And it really just reinforced to us how good it is to have a process and how valuable it was to take some real time and try to let all this activity settle a little bit and help us decide what we made of all this activity, right? So it boils down. One thing that struck me when I was writing is the old adage, if it were easy, everyone would do it, right? And so clearly it ain't easy, and not everybody's doing it, this business of ours. And so we think there are two possible explanations for what has just happened in the markets over the last couple of weeks. One is a market-based, risk-off, systematic, fund-driven unwinding of leverage on positions, both short yen and long technology. That's one explanation, and we're partial to that explanation. The second is more fundamentally driven and suggests that the market believes the Fed is now behind the curve, that the July job numbers in the US were emblematic of an economy that's weakening rapidly and may either be going into recession or potentially could already be in recession. And therefore, investors are selling pretty much everything they can get their hands on. And so that's the second explanation as we have thought through this. And we're partial to the first, as I said, the market-based, risk-off, kind of quant crash type of an event, more than the second fundamentally driven event, because we just don't see the evidence for the more fundamentally driven explanation. And our global risk nexus work that we do as part of our monthly really came in handy here. So the original global risk nexus that we began 7 years or so now focused on economics, politics, policy, and markets in each of the three main regions of the tripolar world: Europe, Asia, and the Americas. 2020, we added COVID. 2022, we replaced COVID with climate. But the original four were really useful in the past week because it reminded us that there were two segments that had volatility incidents, one in the markets, the second in politics, US politics, and then that the other two segments, policy and economics, did not have volatility incidents. And since those are the fundamental underpinnings, the economics and the policy mix really set the stage for the environment for companies to operate in and thus help us understand about outlook for earnings. That's really constructive to us. And that led us to kind of the last point that helps us stay kind of positive on things is that earnings continue to be robust, right? Not only in the US, but also in Europe and in Japan. JP Morgan does some of the best work on this. came out with a piece this morning saying that earnings are coming in better than expected in all three of those markets. And perhaps even more importantly, forward earnings estimates are continuing to be revised up. So currently, 12-month forward estimates show double-digit earnings gains in the US and Asia Pacific and high single-digit gains in Europe. So when we add all that together, that tells us that we want to maintain a constructive outlook, that this is a kind of quant crash volatility spike that's going to ebb fairly quickly and continue to provide opportunity in things like commodities, which have been sold off very heavily on fears of a recession, U.S. small caps, the rotation that's been interrupted, not reversed, Japanese equities, which have been massively oversold, and our pick and shovel play for the AI age, the semiconductor space, which likewise has been sold very aggressively.
Now, with the monthly pieces, like for anyone who hasn't seen these episodes before, Jay breaks it down into 5 different categories: climate, economics, politics, policy, and markets. And with that, we're going to jump straight into climate. Now, on the climate side, are we seeing any good news there at the moment, Jay?
Well, it's been a real, it's funny you ask, right? Because it's been a real Dr. Jekyll and Mr. Hyde environment in the climate space, really for the last couple of years. Dr. Jekyll, who's the good guy, that the good news is in the explosion of renewable capacity around the world that is entering into the grids of the various countries. That's unalloyed good news. The bad news, Mr. Hyde, is the excess capacity and profit destroying nature of the excess capacity in the renewable space, in particular amongst solar and wind, driven in large part by Chinese excess capacity. And that has clearly been a big problem for the clean energy kind of renewable EV space, the whole basket, really. Now, there are kind of 2 pieces of good news as we see it. The first is that in China, the leading solar companies are starting to restrict capacity. And this suggests that with production costs now exceeding pricing, so losing money basically when they're producing solar panels, the idea of expanding capacity is no longer appealing to them. And that's a good sign because they dominate the space. So we're starting to see signs of rationality in the renewable space in China. That's good news. The second piece of good news is that we believe we're at the beginning of a global rate cutting cycle, which should be supportive for the thematic space, including in the clean energy and renewable space. And that's not just our point of view. JP Morgan, Bank of America, others are talking about the most synchronized global rate cutting cycle in 40 years. And that July, B of A reports that July saw the most rate cuts since the onset of COVID back in 2020. And so those things are that sets up a better environment for things that are a little risky, like renewables, like clean energy, that have really been targeted or have suffered from the rate spike that we've seen, the rate hiking cycle that we've seen over the last couple of years.
Let's move on to economics. Now, obviously, we've had that volatility we talked about this week, but are you seeing some stability floating around in economic land?
Well, that's kind of what we touched on earlier when we talked about our global risk nexus. And in the economics front, it is very important, we believe, to note that stability reigns in the macro space, particularly when we look at inflation volatility, which has continued to show signs. We have a great chart in the monthly of global disinflation. And we also continue to see robust GDP growth, right? Q2 for the US was 2.8% annualized. That's pretty darn good when you remember that potential growth rate for the US is somewhere around 1.5%. And it's not just in the US. Q2 in Europe was better than expected. Q2 data for Japan is expected next week. It's forecast to show expansion. And we continue to see policy measures, albeit small but steady policy measures in China to support consumption and help move China from an export infrastructure-led model to a domestic consumption-led economic growth model. And we continue to rely on our 4 for 2024 macroeconomic surprises as our guideposts for the global economy. And they continue, when we produced this last November as part of our 2024 outlook, we highlighted surprise number 1, lower inflation sooner than expected. That, with the exception of a little bit of a pothole in Q1, that has continued to play out, both in the US and Europe. Lower inflation, that sets the stage for the rate cutting cycle. Surprise number 2, better than expected productivity, manifesting very clearly in the US. The productivity numbers for Q2 were very solid for the United States. And this is key because it's productivity that provides the secret sauce for companies to continue to grow earnings when GDP growth is 2% or so. So we really focus on productivity, and that's what's allowing people say, well, how can companies continue to have these high margins, right? Unless they continue to raise prices. Well, the way they can do that when price volatility is declining, as it is now, which is a good thing, the way they can do that is through continuing to enhance productivity. And by the way, the best periods for productivity enhancement are when you have full employment and labor is tight, because that encourages companies to focus on improving productivity. Surprise number 3, return to stability. Got a lot of flack for this one when we laid it out late last year, late last year. Really has worked in the first half of the year. And then, of course, we've had the volatility spike. But look, the volatility spike was the highest since the great financial crisis and since COVID. And we are not anywhere close to either of those situations. Very important to note. We expect the VIX to come back to the 20s and below in relatively short order. It's right now around 23, 24. So that we think we're going to continue to see that stability maintain itself. And then surprise number 4, early cycle, not late. This is our view that we're not late cycle going into recession, that globally we're in fact early cycle. And look, most synchronized rate cutting cycle since the 80s, right in front of us here. Fully employed populaces, right, in the US and Europe and Japan and elsewhere. You have rising productivity. And so when we look at all these things, and you have, importantly, the continued spending by both governments and private sector on AI, on infrastructure, on climate, and on defense in the US, in Europe, and in Asia. And this is something we think people just don't appreciate, how much money is going to be spent in the next couple of years. Sure, all these Infrastructure Act, CHIPS Act, et cetera, were done several years ago. But the key is that the actual spending of the money is coming in the next couple of years, both here and in Europe with their next gen spending. So putting all that together leaves us constructive on the global economy.
Well, let's get on to your favorite topic now. We get viewers from around the world on this. Obviously, some big news this week with Harris choosing her VP. Talk to us about politics, and I'm presuming that this is all going to be about US politics.
Yeah, let's be honest, okay? I send you what I'm talking about before the show. All right? I'm sorry, I don't mean to burst the bubble that you are an all-seeing individual, because you are, but let's also be honest, okay? Yes, he does get it, and that's why he knows what's in it. Okay, so politics. Yeah, the big story clearly is the US, the masterclass in political strategy and tactics deployed by President Biden as he decided to not seek a second term, employing the rope-a-dope strategy, letting Republicans punch at him, let Democrats punch at him for weeks, let the Republicans have their convention where they blast Biden as being too old, where they pick J.D. Vance, who's probably already gone down in history as one of the worst VP picks of all time, and resulting in a complete political jujitsu move, flipping the age thing back onto Trump as Kamala Harris comes on the scene, like full on energy and enthusiasm, fusing in a way politics with the Olympics. I write it in the monthly how it seems the way she's coming out of the gate is if she's on the 4x100 meter team, taking the baton from Joe Biden and just sprinting down the track. And it's evident in enthusiasm, it's evident in fundraising, it's evident in vote and volunteers, and most importantly, it's evident in polling. So right now, pretty much every national poll has Harris ahead on a head-to-head basis. It has Harris, they have Harris ahead in the swing states. And the electoral college results currently favor Harris by 30 or so electoral votes. And the contrast between Harris and Walz, the energy, the enthusiasm, bringing back the joy, we're not going back. It's dynamic. And it even leads people like Frank Lutz, who's one of the most respected Republican pollsters, and I quote him in the monthly, to come out and say that Kamala Harris is ahead, she's the front runner, and she has all the energy. And this has left Trump and Vance and the Republican team in pretty much complete disarray. And so at this point, we are bringing back our Biden in a landslide view that we have been espousing since the beginning of the year. Granted, we retired it on this show after the debate. Debate was Thursday. We talked on that Friday, and I said we have to retire that view. But we're excited to bring it back. And not just because we think that Biden or Harris would be better than Trump. Basically, in our view, as a convicted felon, he should not even be allowed to run. But nonetheless, what's more important is that a Harris victory ensures the continuity of the Biden policy mix, which has left the U.S. as the idol of the developed world in terms of its GDP growth and inflation performance. We want to sustain that for our blue sky global macro outlook that we have for 2023 to 2027. And we think it's increasingly possible that we could have a Democratic sweep of all three, presidency, House, and Senate, which I think probably would lead to a little bit of a market pullback. People have a kind of a inherent fear of any one party dominating. But in our view, that would sustain the policy mix that we think will allow the U.S. to continue to demonstrate leadership in its global growth performance.
Well, you mentioned policy there. Now, Monday, there was talks of an emergency 25 bip cut because the market went down for 2 days. Shocker. Never seen that before in history. Where do you think we are with policy? I just saw a headline come through before that like the bets are getting taken off of 100 basis points of cuts by the end of the year. It's just ludicrous in my mind. But what are you seeing on the policy front?
Yeah, we would agree with that perspective, Scott, that, people got way ahead of themselves in a lot of different levels and a lot of different places. And all that unwind is, creating some continued kind of tremors, let's say, after the main quake. But, we're much more focused on the fact that we've switched from one of the most aggressive rate hiking cycles to a global synchronized rate cutting cycle. And the Fed is late to the party, but will join in September. I think that's a given. 25 or 50, not really all that important to us here at TPW Advisory. 2 or 3 more cuts this year versus 1 this year and 2 next year. Also not all that important. It's the direction and the trend that is important, not the magnitude of the cuts. And certainly the idea of an emergency rate cut is just completely off the table, right? It's not even, I mean, I think that just was kind of crazy talk. The thing that we are paying attention to, and we spent most of the policy piece on, we've already touched on, so I won't belabor it, but it is this idea that we have significant amounts of investment ahead to deal with AI, climate, infrastructure, and defense. And that is going to be global, not just in the US, not just in Europe, it's global. Sovereign AI is not just a talking point, it's a reality. Every country needs and wants to have its own sovereign AI space. Every country needs to deal with climate. Every country needs to have its infrastructure in place to be able to accommodate the manufacturing, reshoring, and regional integration that's at the heart of the tripolar world. And so this to us is, as I said earlier, very underappreciated. And yet it is the thing that's going to provide the underpinning for a continued global growth expansion, which gets us back to that surprise number 4, early cycle, not late, return to stability. All these things are interconnected and is what allows us to kind of ride through the last couple of weeks. Our clients and ourselves at TPW Advisory ride through the volatility because none of this is impacting in any meaningful way these big trends which are continuing to power ahead. And that to us is the policy that we want to focus on, not the ins and outs of 25 basis points versus 50, meaningless really in the big picture part of what we are talking about as a blue sky period for 4 or 5 years, 2023 to 2027. And that is what we're focused on.
All right, well, that leads us into the last one, markets. Now, we record this on Friday afternoons. Markets looking pretty, just a little bit down, nothing crazy. Markets actually surprisingly pretty well flat for the whole week, despite the panic that CNBC was giving to everyone across the street on Monday. Jay, as we said, we're not looking backwards, we're looking forwards. Let's talk about the markets and what you see going ahead.
Yeah, no, the CNBC market's in turmoil. That's one of the best all-time indicators, right?
Yeah, I think it's up 100%. 100% of the time they do it, the market's up 12 months later.
Yeah. When you see that headline and you see that ticker, that's when you want to step in and buy. And it's the old adage, when you should be buying is when you don't want to buy, right? Because it's natural. We're kind of hardwired as a species, I think, to, look for upside and want to join the party as opposed to like step into the burning building and and rescue an heirloom or something. So I mean, it's perfect, right? The market's going to end up roughly flat. So if you went away, on Sunday and came back tomorrow and didn't look at anything during the whole week, you'd assume nothing had happened, which is just, crazy. So the way we laid it out was we looked back over the last 3 months. ACWI is flat, global equities. AG bonds are up 3%, and Goldman Sachs commodity, GSG, is down 5%. At the same time, you've had inflation come down, rates come down, growth be robust, and earnings better than expected. So that's a pretty good environment, those 4 things. Inflation down, rates down, growth up, earnings up. Okay, as an investor, we'll take that. And going forward, it gets better because investors are going to have central banks at their backs, right? Providing that synchronized global rate cutting environment. And in our view, potentially, as confidence returns, allowing some of the absolutely massive savings pools that have built up around the world, the money market mountain we've talked about at some length in the United States, $6 trillion. $6 trillion in money markets in the United States, or the massive savings in China that built up during COVID and post-COVID. China's savings pool is just absolutely humongous. Or if you look in Japan, the famed Mrs. Watanabe, in her purse stuffed full of yen notes. There is a lot of money. Again, we think deeply unappreciated, a lot of money sitting in money market accounts that when confidence returns, you could see some of that money start to flow into riskier assets as governments or central banks are cutting rates, making them somewhat less appealing. So when we look into year end in 2025, we see rotation, not recession. We see opportunity, not downside. And so we remain relatively unchanged with our view, right? As a reminder to viewers, we update our models, our global multi-asset and our TPW20 thematic model once a month. And that comes up next week. We do the monthly first, bring everything together, then update the models next week. We stick with that process. Process is key, as we said at the very beginning, particularly in volatile periods like this. So we see a lot to like, particularly in the miners on a 12-month basis. Copper miners, uranium miners, gold miners, all been hit hard, particularly the first two. A lot of opportunity we see there. We see continued opportunity in the semi space, in the pick and shovel of the AI age. That's not changing, right? I mean, you had Microsoft, you had Meta, you had Amazon, all reaffirm their massive CapEx spending plans on AI. And that means demand for semiconductor chips. And that means we want to take advantage when semis are sold off by 30%. I think SMH at the low was down roughly 30% from its recent high. That's a very healthy, very strong pullback and correction. And look, corrections like that, always painful in the short term. In the long term, positive. They clear off the excess sentiment. That's been gone, right? No more excess enthusiasm. That's taken out. That's good. It rebalances things. We're in process of doing that. And it provides ongoing opportunities for investors to step back in. And so when we look at the other asset classes, we continue to be underweight fixed income with a focus on credit. We really don't see, with our global growth outlook, don't see much appeal in a 4% 10-year U.S. Treasury. So we want to stay with credit. The economy is fine. Again, credit's been a good signal the last couple of weeks, last month. No real upset in the credit space. Defaults continue to come down. We have a great chart from Apollo showing how defaults continue to decline in the credit space. And so credit, we continue to like. We think it's going to be more appealing as central banks cut. That extra yield you can pick up in the credit space going to be appealing. And we continue to think that there are opportunities in Japan, massively oversold, in the small cap space in the US. That rotation has been interrupted, not reversed. And we think the dollar has seen its high for this cycle and should continue to weaken as the Fed starts to cut, as the rest of the world starts to pick up, and as that growth differential between the US and the rest of the world narrows. That should be bullish for money to start to move into other parts of the globe. The dollar is the most overowned asset in the world, and we think it's seen its highs. So bottom line, we want to stay the course. We want to trust our process. We want to leverage things like our global risk nexus, leverage things like our 4 for 24 surprises, and continue to look forward into what we think is going to be a pretty bright next couple of years.
Jay, as always, I love the monthly. It's always a great breakdown to review everything globally. You have a fantastic weekend. I hope you enjoy watching the breakdancing at the Olympics over the weekend.
Thank you. You as well, Scott. Take care.
Thank you. And for everyone else out there, good luck investing.